Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, George. It's really good to have you on the podcast show.
Thank you. I'm very glad to be on it.
I've been a long-time follower of you, especially on Twitter. You're very vocal and you're somewhat of an iconoclast, I guess, when it comes to monetary policy and the Fed. You really sort of stand out. But before we go into your thinking, I do like to ask all my guests something about their origin story. So in your case, what did you study as an undergrad and how did you end up in the field of economics?
Well, it's a good question because my story is a little unusual. I started out with a very keen interest in marine biology, and I was majoring in zoology, and I did ultimately major in zoology at Drew University, a landlocked university in New Jersey. But I spent a lot of time at marine labs and pursuing that interest. But at one point, while there was still time, in part because my father encouraged me to do so, I took on economics. I had already a bit of an interest in it and made it a second major. And so that's the story. There's more to it. My father was basically a socialist. So he was hoping his son would become another socialist economist, or at least somebody who was going to go after these despicable free market types. Didn't work out that way. My father was rather disappointed, to put it mildly, but he did help get me interested in the subject. And finally, after graduating, I tried to pursue both interests. Very long story, and I won't take up too much time with it. But to make it short, I ended up deciding to put the marine biology and aquaculture, which is a particular interest of mine, aside, and to pursue a PhD in economics at NYU. And at that point, I was already interested in monetary economics, which has remained my special interest ever since.
And just out of interest, are there any sort of parallels or between marine biology and economics, do you find?
Oh, absolutely, yes. From the very earliest stage of my interest in economics, I saw it as very similar in its underpinnings and in the questions it ought to raise, and often did, to ecology, which was, of course, a subject I studied as part of my overall pursuit of a zoology degree. And in particular, I thought it was very interesting to think about the natural ordering processes at work in human societies, which, of course, are analogous to those in many other biological systems. And I was interested in the dangers posed by unthinking intervention in these self-ordering processes. So I think once you have studied ecology and heard the horror stories about the Army Corps of Engineers building dams and causing consequences no one anticipated at the time, it's a pretty smooth transition to Adam Smith and all that. It wasn't hard for me at all, though it gave me an emphasis to my thinking that is not necessarily shared by many other economists. So I was very much interested in the spontaneous ordering processes at work in human societies. And my monetary economics research has itself, of course, been largely, not entirely, devoted to looking at how you can have spontaneous monetary systems and how they can function.
Yeah, no, that's great. No, it's an interesting parallel, and it makes a lot of sense. I also note that you're in Granada, in Andalusia, in Spain. That's I wouldn't expect many people like yourself, sort of living there, an economist, focusing on the Fed and such. What brought you to Granada?
Well, that move, it doesn't have much to do with my interest in economics. It was entirely personal. It was because of my interest in Andalusia and Spain and wanting to spend more time here because I like it. Because it's a great place to live. I'm extremely happy here. And so that's all very personal. To make the move, I of course had to first step down from my director's role at the Cato Institute. That role now being very well played by Norbert Michel, who's now running the Center for Monetary and Financial Alternatives I established at Cato. And my role now is purely research, specifically lately writing books, including one I'm wrapping up on the New Deal and the Great Depression. So I'm able to do the work that I now do for Cato at long distance. So Granada isn't a constraint, but it's certainly not a requirement for my work.
And just out of interest, if you are in a place like Granada and you're outside like Boston and New York or London, I mean, do you find that it impedes your ability to do research or not?
Not really. When I was in the thick of it in the United States, I wasn't particularly keen on attending professional conferences and that sort of thing. Of course, I did so as during my university years, especially. I taught university for 30 years before moving to Cato. So I had to do my share of professional meetings and professional networking and all that, but I was never very good at it, and I didn't really enjoy it all that much. And so once it wasn't necessary for me to attend these events, I pretty much stopped doing it. So now there are things I would like to take part in the United States and elsewhere, but I do go back to the States now and then, particularly for Cato related events. But there aren't that many of them, so I can do so without great inconvenience.
Okay, no, that's great. Now, of course, your big focus has been on monetary economics. So maybe let's focus on the Fed, or start with the Fed.
Right.
And I suppose in terms of big structural changes, the global financial crisis was very important in terms of how the Fed has interacted with the economy and how it conducts monetary policy. So, in your eyes, what were the big sort of changes to the Fed from GFC onwards? I mean, what was it that kind of were the big changes that occurred that you think are very relevant for us today?
Well, first of all, I agree with you entirely that there have been major changes. It would not be too much of an overstatement to say that anyone who learned their monetary economics before 2008 had to relearn it afterwards, because so many of the operating procedures of the Federal Reserve changed as a result of the crisis that took place then and the Great Recession that followed. So the biggest of these, which I wrote a whole book about some years ago, was the change that took place not just in the United States, but in some other countries as well, from a scarce reserve monetary system, that is, one where bank reserves were made available only in limited amounts and where banks were not encouraged to accumulate reserves, to an abundant reserve, or so-called floored operating system, which has been the norm in many countries, and has been the norm, I should say, in the post 2008.
And just to be clear for our listeners, the reserves are the reserves held. So banks hold them at the Fed, at the central bank.
That's correct. Yeah, banks can hold reserves either as cash or as deposits at their central bank. And in the old days, they kept a relatively small quantity of such deposits, often determined as much as anything by legal requirements. as they could possibly get away with, because the reserves didn't earn very much. They, in the United States, for example, until 2008, reserves paid no interest. So banks would hold them only to the extent that they had to, either for regulatory reasons or for the purpose of settling interbank balances and occasionally paying out cash, of course, to their customers. Otherwise, they would try to invest most of their resources in interest-earning loans and investments. So the reserve ratios, in effect, were very, very low, the ratios of reserves to other bank assets. Since the fall of 2008, when banking systems were all struggling, the switch has been to a situation where banks are holding large quantities of reserves, and this involved two changes. First, of course, the creation of a lot more reserves, but just as importantly, the transition to central banks paying interest rates on reserves that actually made reserves attractive rather relative to other investments. Because, of course, if they weren't attractive, the banks wouldn't hold on to them. Of course, they would have to hold on to reserves in the sense that any reserves the central banks create are going to stay out there until they change their mind. But what would have happened in the absence of interest on reserves is that banks would have expanded their other loans and investments, putting these reserves to use essentially but to create more other low investments. And you would have ended up once again with very low reserve ratios, but with very, very large quantities of bank deposits and other investments. Instead, with interest on reserves, banks have been encouraged to accumulate reserves as a large share, much larger than in the past, of their total investments.
And so, I mean, the first question I have was, why did they need to create so many more reserves? Was that linked to QE? Was it because on the, because of the large-scale purchases of assets required these reserves to be created, or?
In the United States, because every country had a somewhat different story. In the United States, what happened was somewhat involved. At first, the Federal Reserve was engaged in a lot of emergency lending that fall of 2008. But at the same time, and this was a perverse, in retrospect, certainly a perverse aspect of what they were doing, they wanted to make sure interest rates didn't fall to zero. And interest rates were falling quite a lot. Of course, the more loans they made, the more reserves they were injecting into the system, which meant that as banks turned around to dispose of those reserves, interest rates would fall. So in order to discourage them from lending all the reserves that were being created, at this point only as a consequence of emergency lending, not deliberately. So this was QE zero. It was not meant to be QE, but it looked like QE. The Fed decided to seek permission to start paying interest on reserves in a deliberate attempt to get banks to not lend the reserves the Fed was creating, to stockpile them. And this was all part of an effort to keep interest rates propped up, to not let them go to zero. And I say this is perverse because in retrospect, we needed to have easy money then. So what's the point of lending a lot to specific institutions and types of institutions, while at the same time you're trying to keep interest rates high? In a macroeconomic crisis, what you want is low interest rates and general enhancement of liquidity. So in retrospect, they should have let interest rates go right down to zero.
And you mentioned permission. They needed permission to charge interest. Permission from who? Was it some legal issue here?
From Congress.
Okay.
The Federal Reserve statutes, as they existed prior to October 2008, did not allow the Fed to pay interest on reserves. Now, it so happened that a law had already been passed that was going to introduce interest payments on reserves some years after. In 2011, they would have been able to pay interest on reserves. But now the Fed wanted to do it right away. so it had to get permission to accelerate the implementation of that new authority, and that's what happened in October 2008. But they also did something else. The original law, the intent of the original law, and that and what is actually stated in the original law was that the Fed could pay interest on reserves, but it couldn't pay more than the overnight market rate. So the original law was clearly not intended to make reserves more attractive than other overnight or short-term loans. The Federal Reserve didn't get that condition changed, but they turned a blind eye to it or thumbed their nose to it. And what you ended up with was interest being paid at rates that by any reasonable definition exceeded short-term market rates. Because, of course, if they didn't, then the interest on reserves wouldn't have served what was then the Fed's purpose, which was to discourage bank lending. By the way, I should step back and say the original intent of interest on reserves was simply to reduce the costliness of banks of holding reserves to meet legal requirements. So it wasn't about discouraging lending. It was just to make the reserve holding banks did, such as it was limited, was to make it less costly to them to meet reserve requirements. It was never intended to be something that encouraged banks to hoard vast amounts of reserves.
Okay. I mean, in some ways, was that a backdoor way to recap the banks, would you say, or not? Was that, I mean, is that assigning too much intent to this?
I don't think it was quite that, but of course, it ultimately made life easier for the banks because you're giving them a zero risk asset that they can buy that earns interest, right? So this is clearly going to help the banks. It's going to improve their position in the short run, so banks, of course, setting aside changes in liquidity requirements, which also were coming at this time, but putting those aside, by giving banks the option of holding reserves and earning interest on them, but not requiring them to up their reserve ratios, the authorities were obviously doing the bankers a favor because it's one more option. It's not a constraint. Now, liquidity requirements, of course, made mandatory what interest on reserves only made attractive. And that's a different story, of course.
Yeah. And then the continuity of the abundant reserve system, it's one of those cases they created that, and it's easier to maintain status quo. And then they did QE, like formal QE. And
that's right. That's correct.
They came up with justifications to maintain it, and you end up with this path dependency, with this sort of system. Is that?
That's correct. It's very clear from the record that the Federal Reserve stumbled into its floor operating system or abundant reserve system because of its attempts to keep banks from lending. So it's ironic because we think of that system as somehow having been designed to help get banks to get the economy out of the recession, but that wasn't really the case. In any event, they stumbled into it, and then they maintained it until 2019 as a temporary change. But in January 2019, the Fed announced that it was going to make this a permanent arrangement. It had embraced this new system that it stumbled into. And of course, in the meantime and afterwards, various Fed officials made arguments as to why this was a good system worth keeping. I think that if you go back and look at those arguments and actually look at how the system has ended up working, those arguments have not aged very well. To give an example, it was said that this would be a much easier system to administer. Once you have abundant reserves, monetary policy was supposed to become a simple matter of setting the interest rate paid on reserves, and that interest rate would rule the roost. It would determine where all the other interest rates in the economy went. What could be simpler? This arrangement dispensed with any need for the Fed to fine-tune the quantity of reserves in the economy through open market operations or otherwise to keep interest rates where it wanted them. It just had to set and forget. In actual practice, things didn't work out that way. It turned out that interest on reserves in the U.S. wasn't sufficient to prop up interest rates all the time at that administered rate. Instead, for reasons we can go into if you like, but there was a tendency for the interest rate floor, so-called, hence floor system, for it to leak, for interest rates to sag below. And that led to the establishment of the Fed's overnight reverse repo facility, sometimes said to have been the subfloor put below the floor of interest on reserves. Then they also had problems with interest rates spiking above the interest on reserves, which is now supposed to be the upper bound of the interest rate, overnight interest rate. So they found interest rates spiking above the interest rate on reserves, and in response to that, they ended up establishing the standing repo facility. And so, to make a long story short, this supposedly very simple arrangement for regulating interest rates and thereby establishing the stance of monetary policy turned out to be quite complicated.
So it wasn't simple, which it was supposed to be, and it didn't reduce the interest rate volatility, which it was supposed to do.
That's correct. It did reduce it to some extent, but it didn't, but only after the creation of a number of new facilities that had to work in conjunction with interest and reserves. It wasn't a simple matter of just picking an interest rate on reserves and then you were finished. It's a much more complicated arrangement. The other thing that has happened that was contrary to expectations was that the quantity of actual reserves required to make this system of abundant reserves work has turned out to be far larger than anyone anticipated. And indeed, here again, if you'd gone back to the days when this was being debated, and you had said to the people, let's say you show up at one of the meetings of the Federal Reserve experts who are discussing this transition, and you said, by the way, I'm God, and I just want to let you know you're going to end up with a $8 trillion balance sheet just to keep this thing working. Assuming that they believed you, or believed me, they would have said, oh, forget that, and that would have been the end of it. So a lot of things that have actually happened, had they been anticipated at the time and had people known that they would happen, there's no way that they would have gone through with it. They couldn't have justified it.
And but now, at the same time, okay, so it turned out to be much bigger than they expected. But in the end, banks earn a bit of interest on their reserves, which is nice for them. And what's the dark side of this? What's wrong with it? I mean, what's the real impact of this? Or how does it impact the financial system?
Well, as people would have noted at the time, if you had pointed out the size the thing would grow to, there are disadvantages to the Fed's having such a large footprint on credit markets. In fact, before 2008, the Fed was very proud of having a very small footprint. And the reason is that they want to not be interfering with exactly how scarce credit gets used in the economy. Apart from regulating its total availability, they didn't want to interfere any more than necessary with how it got allocated among competing uses. We now know that the very large Fed footprint that is a result of the floor system does also entail some greater interference with the allocation of credit. There are some interesting studies showing how, for example, reserve holding has to some extent crowded out ordinary bank lending. It needn't have done that because it could just be that much extra assets in the system, right? And then you have a layer of reserves, and then you have layer of bank lending that looks just like what it would have looked like if the layer of reserves had still been small. Well, that isn't the case. Without going into the details, there are some good studies that show that no, that at the margin, this is having some effect on bank lending, and it's not insignificant, and on the allocation of bank credit towards uses other than investing in the Federal Reserve, which is what interest on reserves causes banks to invest in the Fed's balance sheet, right? Not other assets. That's the difference. So there's some trade-off there. The other thing that's very important has to do, to get back to ecology, with the old ecology of how the banks self-regulation worked. A part of that self-regulation, and of course, the United States banking system is very far from being a free market. So when we talk about self-regulation in the banking system in recent times in the United States, we're only talking about one component of the overall regulatory picture. Still, that component was important. And this had to do with the fact that in a scarce reserve system, banks were routinely borrowing and lending to each other overnight. There was an active federal funds market, which is the market for lending and borrowing bank reserves within the banking system. Now, why was that active market important? Of course, it helped banks to make do with very few reserves, because banks that had more than they needed could share them or lend them to banks that didn't. But this had a side consequence that was very important, and nice articles were written at the time about this. It meant that banks formed relationships with other banks for short-term, or if you like, emergency lending. It meant that they monitored each other, that they learned which banks were safe and which banks weren't, that they had an interest in building their own reputations so that they could take part in those markets. And among other things, this interbank monitoring that overnight Fed funds lending encouraged had the effect of limiting contagion effects in the banking system. That is, contagion effects break out when a bank fails, and because other people aren't aware of which banks are heavily involved in its failure, that you can have spillover effects where banks that are actually perfectly sound start to suffer disintermediation. Nobody will lend to them. Ideally, in a perfect world, banks know which banks are really sound and which ones aren't. That limits contagion effects. That means that if there is trouble anywhere in the banking system, it doesn't tend to spread like a contagious disease to the rest of the system. The federal funds market provided that information. That's been absolutely destroyed, not just in the US, but in every country that switched to a floor system. The difference between the US and those other countries is, if you look at those other countries, you'll find they're all discussing getting away from the floor system to revive the federal funds markets, or the equivalents of those markets in these other places. And some have already taken steps in that direction. As is too often the case, the Fed is the laggard. It is basically playing a game of see no evil, hear no evil, whatever, speak no evil, by ignoring this problem and pretending that the killing of the Fed funds market isn't something of it that anyone needs to be concerned about. So there's some examples of how the switch to the floor system has had bad unintended consequences.
And then in some ways, it sounds like this may have contributed to the weak growth we saw in the US after the global financial crisis, because the Fed was in QE, rates were low, so you would have thought that there would be all of this monetary stimulus over this period of time. Yet growth was relatively stagnant. So I mean, would you kind of link the two together, or is that not
to a minor extent? The great irony is that interest on reserves can only serve one purpose, which is to keep interest rates higher than they would be without it. It can't make them any lower, right? And so in a crisis or recession like that since after 2008, the only thing that interest on reserves did is what it was originally supposed to do, is keep interest rates from falling to zero. But why, in a macroeconomic slump, do you want to keep propping interest rates up? In fact, as you know, and as your listeners will mostly know, the interest rate setting on reserves, once it was clear that the economy was in a deep depression, ended up being set very low, though not quite to zero, which kind of begs the question, how is this system helping? Interest rates under the old system would have gone to zero all the way, not because of an intention on the Fed's part, but because there was no interest on reserves to prevent them from going to zero. And what would have been wrong with that? Well, the argument was that we needed to have prop interest rates up for the sake not of banks, but of non-bank intermediaries like money market mutual funds and all that. But if you think of macroeconomic policy as a simple matter of setting interest rates where they need to be given the circumstances, for the purpose of stimulating credit as enough, but not too much, then surely interest on reserves made very little sense as a reform to introduce just before the worst economic downturn since the Great Depression. It made no sense. So you try to look at what happened and you say, okay, here we have the biggest depression since the 30s, and we have the Fed deciding to pay interest on reserves. And you're trying to square that circle. You're trying to make these two things make sense. It's not easy because it is not a simple story of a macroeconomic policy aimed at making it easier for the Fed to do its job. If anything, of course, you could have made a case that allowing the Fed to pay negative interest on reserves would have been an appropriate step to take under these circumstances. Now, that's an argument that isn't hard to make. One can point to problems of paying interest on negative interest rates on reserves, of course. Nevertheless, from a simple macro point of view, it would have been sensible. But the Federal Reserve never embraced interest on reserves for any reason other than that of paying an interest rate above zero. And nobody is talking about going to negative rates. So it's a very interesting and strange story.
And then last year's regional bank crisis, I mean, how would you view that in relation to the Fed and this, what we've just talked about?
Well, the main point there is that, of course, interest on reserves and abundant reserves for banks in general is not a panacea. It's not going to prevent particular banks or groups of banks from going belly up. It's not going to spare bank regulators the need to be diligent and to be looking out for problems. And so nobody can say that, okay, interest on reserves has been a pretty weird move macroeconomically speaking. It hasn't made life a lot simpler for establishing the Fed's monetary stance. But look, it makes banks generally safer, and so we don't have to worry about banking fiascos. Well, that's not true either. It's simply not true. Even banks that hold abundant reserves can get in deep doo-doo. But the other point is that abundant reserves means that in practice, there are some banks sitting on vast quantities of reserves and some banks that don't have all that many excess reserves, tend to be concentrated in a small number of very large banks. But even so, if a bank can have abundant reserves and is very badly managed, and certainly if it engages in enough fraud, it can still fail. and so we still have a problem of inadequate bank regulations when it comes to the microeconomic side of the story. we haven't gotten a free pass there from interest on reserves.
And of course, since COVID, we've had this outbreak of inflation, and the Feds had to deal with that. So they were late to start with in terms of raising rates. They've raised rates
That's
significantly.
right.
Inflation started to fall now, so there's talk of the Fed cutting rates. So, number one, I mean, what do you think was the cause of inflation after COVID? Because there's been lots of debates around this. Was it kind of supply chain issues? Was it the Fed was too generous with monetary policy early on? Was it fiscal? And there's criticisms around the Fed's timing. So I mean, first, if we start with that, like, what in your view, what has caused this inflation sort of surge?
Well, to start with the general answer, both supply and demand side factors were behind the surge of inflation after COVID. During COVID itself, you look at the behavior of the money supply, and you look at the behavior of velocity, which is a measure of how much spending people are doing with the money they have. These two things were largely offsetting one another. The Fed's actions could be defended as a part of an effort to keep spending from collapsing more than it did. But when you add to the Fed's efforts the tremendous, unprecedented fiscal stimulus that was also part of the reaction to COVID, and which was also a part of the reaction that is much harder to reverse or undo. Once the recovery started from COVID, once people started spending again, you ended up with demand growth that quickly made up for the collapse of growth in the past, or fairly quickly. Now, it still could be argued that we needed to let demand and inflation overshoot for a while to get back to the long-run trend path that was in effect in place before the crisis. And I also should say that as a result of COVID, as everybody knows, there were very serious supply side shocks that reduced real output and added to inflation because of that. I don't think that any central bank should try to combat inflation that has supply side roots. I've argued in many places that that's just adding insult to injury. So as far as I'm concerned, the inflation and demand growth that took place for some time after the COVID crisis was okay, was justified. But at a certain point, it was clear that demand growth was continuing at rates that were propping up or adding to inflation without being justified any longer by the need to make up for the past collapse of spending. I want to get my dates right, I think it was around November 2022 or August 2022, sometime in the late summer of 2022, when I wrote saying, okay, I think it's time to raise rates. There were all kinds of indications that demand growth had recovered to the point where now it was growing too fast to be consistent with not aggravating inflation. And I do believe that the Federal Reserve was very slow to raise rates. It should have raised them sooner. At least it did so eventually. And as I've said to other people, I don't think it's right to say.
Sorry, just great. I think you must have written the article late 21, I think. I think you said 22.
I said 21. I'm sorry.
Yeah, no, it's okay. It's okay. It's okay.
2021. I think that on the whole, I wouldn't give the Fed very poor grades for the way it managed this inflation, given the fact that it has little control over what's happening on fiscal policy, right? I would give them a B or maybe even a B plus. It could have been a lot worse. But if they wanted to earn an A from me, they would have had to start raising rates sooner. And I think had they done so, they wouldn't have had to raise them as much, and they wouldn't be contemplating having to lower them as much or lower them again as they are now. So I think we would have had a somewhat a smoother interest rate history than we've actually had.
And just in terms of the pace of rate hikes that they've had, many have been surprised by the fact that they've raised rates so aggressively, yet the economy hasn't fallen into recession, nor have stock markets collapsed, which you would have expected.
Right. Yeah.
Unemployment hasn't surged. All the normal things you see historically when you see such aggressive Fed actions. What do you think is behind that?
I wrote about this too, and I've always been I've always insisted during this process that that tightening, which I argued was desirable in 2011, as you point out, it didn't have to come at the expense of employment, let alone at that of causing the economy to plunge back into a recession. And that's because, well, first of all, it's because there's a big difference between slowing down demand growth and having demand shrink as it did in the time of the COVID crisis. Second, as all economists should understand, much depends on whether the policy is adequately anticipated, right? We don't go riding up Phillips curves and getting more employment when we expand demand if the expansion is anticipated. Well, by the same token, if a slowing down of demand growth is anticipated, then it need not have any adverse effects on labor markets or on economic output. So it was simply a question of the Fed's move, how much the Fed's attempts to rein in inflation were understood, were anticipated, and therefore didn't shock anybody, or cause labor markets to be seeking extra wage growth beyond what the new Fed stance would permit without causing unemployment. So expectations are very important, and I feel like a lot of people in this course of this debate about how much harm Fed tightening would do seem to lose sight of the basic points about expectations that we all learned back in the 80s when the new classical economists were drumming this into us. Ironically, I think some of those new classical economists were among those who were now more recently predicting that tightening had to come at the expense of labor markets. So I was very confused by this. Anyway, I didn't think it would have to happen. The fact that the labor force, that there was a lot of slack in the labor market going into this inflation also meant that the odds were that some tightening wouldn't cause any problem because there were more jobs out there than available, and there were people to fill them. So under those circumstances, you can tighten and nobody's gonna not get a job because of it, and so on. So anyway, I did favor the Fed tightening sooner than it did. I did not think that its doing so would have to come at the expense of workers or the economy in general. I did not think as well, since it's probably the next question, that inflation would have gone away all by itself without tightening. To that extent, I was not in the transient camp at all. And I still don't understand transient types taking victory laps. I had a little thing online you may have seen on X where I imagined a conversation between a team transitory person and a team permanent person, where the transitory person says, "Oh, this is going to go away all by itself. The Fed doesn't need to raise rates," and the permanent person says, "No, they have to raise rates if inflation's going to stop." And then I say, "Okay, the Fed raises rates. inflation comes down. Next conversation, team transient. See?
Yeah.
That's what the debate kind of looks like to me. So I very much doubt that we'd be back to uh, relatively modest inflation, not as low as we like or as Fed officials like. I don't think we'd have gotten here without those rate cuts at
And
all.
on inflation now, do you feel like inflation is essentially under control now? We're on our path back towards, say, around 2%. The Fed can now cut rates at some point. We're in that environment now, rather than, we need a Volcker moment, where they need to kind of, make sure every inch of inflation is squeezed out the economy.
Yeah. But I don't think the Fed has lost control of inflation at all. Whether in fact it's okay for it to cut rates right now is a much more difficult question to answer. My sense is that they're probably wise to stand pat a little bit longer, but this is not one of those cases where it's obvious the Fed can't cut or obvious that they should cut. But because we still have to consider the reactions of the public to any such cuts. But I think that reasonable people can disagree with the stance that the Fed is taking right now. But I don't think that they've lost control of inflation or are in any danger of doing so. This is not a case where inflationary expectations are tending to take off. I think most people understand that the worst of the inflation crisis is over. Certainly, they understand that the supply side factors that were contributing to it have been diminishing, becoming much, much less important. And they understand that the Fed is actively engaged in worrying about inflation and has taken already substantial steps to rein it in. So there is more confidence in this Fed in that regard, or there ought to be, than there was in, say, the Federal Reserve circa 1979, when the Fed was going around, Fed officials were going around blaming unions and all that. So I think we're not in that sort of situation where inflation is at all threatening to become uncontrollable.
And how about the growth picture in the US? So US growth has been relatively solid. There's been some recent weakness over the past month or two, but generally speaking, most people expect US growth to be 2.5% this year. People have sort of veered away. They could, people initially were calling for recession this year, but now they're less likely to. How do you see the growth picture?
I don't want to make a prediction about growth, simply because I don't pretend to know how things can evolve, particularly with a major election coming. For all I know, we'll be having riots in November, and all the problems that could result in. So I don't really want to make a prediction about that. I will say that I don't think that the Federal Reserve is presently doing anything that makes a crisis of any sort or a recession inevitable. But I can say with even greater confidence that yes, eventually we will have another. It may not be very serious, but we haven't licked the business cycle at all. The Fed's record could be worse, but the Fed has certainly not shown itself to be a panacea. So we'll have another downturn, but I have no idea when. A lot of my friends have been predicting a downturn as a result of what they see as an excessive stimulus these last years. They see an Austrian tight boom bust cycle in the making. I'm not at all convinced by that. And I believe that the very fact that that we've been going on so long without any major correction suggests that whatever is going to cause the next recession, it isn't the excess stimulus that we've had, but it'll be other causes. I think the stimulus has already done whatever dirty work and whatever good work it's going to do.
And you mentioned elections, you sort of mentioned sort of riots, but aside from that possibility, what concerns you most about the election, or say Biden wins or Trump wins? Say Biden wins, maybe that's the sort of simpler one. I mean, is there any impact you think for the Fed, or and then if Trump wins, what do you think the impact would be?
I'm just concerned, like many people are, that whoever wins, the people on the other side are not going to be satisfied with those results, and they're going to take to the streets or otherwise protest them in ways that could prove to have some adverse economic consequences. I don't want to go on a limb. I'm even worse at predicting revolutions than I am at predicting macroeconomic fluctuations, which is to say, have no ability at all. But this is going to be obviously a particularly contentious election. And the polarization of politics is so extreme today. People are very, 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 very angry. And there's just no way that the results of this election are going to come out in a way that doesn't leave a very large, sizable proportion of the American public really, really pissed off. And well, I'm in Spain, so I can partly so I can avoid the the results of this turmoil. But I don't think we have very happy times coming for the United States politically, and unhappy political times are usually not happy economic times.
And there is talk about the Fed's independence if Trump was to win. He's made noises around being unhappy with the Fed. I mean, he could presumably change the board, in various different ways, and he could talk against the Fed. Yeah, I mean, how robust is the Fed's independence?
Well, it's never been very robust. Presidents, particularly, have always tried to put pressure on Fed officials, usually to keep money easier than it has been. And they have sometimes been very successful at it. But although I don't think that the Fed's independence is very robust, I think it exists. That is, it's there, it's important, and that's why Donald Trump is unhappy with Powell, because unlike some past presidents who got their way with their Fed chairs, he didn't. At least he didn't get it as much as he would have liked. And the proposals we're hearing about are results of that dissatisfaction with that fact. So these proposals are out there, in short, because the Fed has some independence. And I, for one, would like to see it keep what little independence it has. I think it's very important to have someone in the federal government, some group, whose job it is to keep a lid on inflation. Even though the Fed does not do that job perfectly, no one else has that responsibility at all. So, like it or not, that's the reed we have to lean on. And if we weaken it even further through any sort of legislative change that would give more power to the executive, particularly, but I think this goes for giving more power to Congress over monetary policy as well, we can expect the results to be easier monetary policy, not tougher, not harder, and a greater tendency or greater risk that inflation will rise again to levels that are not conducive to economic prosperity. So bad as the system is, it can be made worse. And so I think we should be very aware that as much as we may criticize the Fed, it's not quite as bad as it could be with the wrong kinds of reforms. Now, I'm not at all opposed to Congress having oversight of the Fed. Congress, mind you, and of course that's its purview, and it could have more oversight than it does. The present dog and pony shows that are reckoned to be the Fed's way of answering to Congress could have a lot more substance to it, and there could be more avenues for Congress being able to actually have some teeth when it comes to finding fault with the Fed's policies. But that is not what I gather is all there is to the proposals that are being mulled by the Trump administration. So we should be very wary of what those proposals would do to the Fed's inclination to care about keeping a lid on inflation.
And one point of contention is that the Fed has a large balance sheet, and it's now suffering unrealized losses and losses. Is that something you're concerned about more generally, even outside of elections? Is this something that we should worry about, or is it just a theoretical point because the central bank has a printing press?
Yeah. It's an interesting question. I am a little worried about it, but only as a very long-term problem. That is something that could become a real problem after some years. Presently, the Fed's losses, they're only they're losses that are not being realized, and they have as their counterpart very large gains that the Fed made, also as a result of having a big balance sheet when interest rates were low. So, there's two sides to this. The problem that I see is that the Fed's practice now of creating deferred assets, as it calls them, as a way of dealing in an accounting sense with the depreciation of its bond portfolio, that makes sense on the assumption that future gains will kick in and that it therefore can offset these losses eventually, or will make up for them in the future. What it does in the meantime is it books this deferred asset. So it's basically saying, we're making losses, but we're going to make future gains. So we have this asset that's future gains, and we offset that. In the meantime, they don't pay any revenue to the Treasury. They cut back their payments to the Treasury while this is going on. The problem is that under the floor system, the Fed is always going to be buying up. If it's going to be expanding its balance sheet, it's going to be doing so. It's going to be buying up securities, usually long-term securities, when interest rates are low. So here you have this, as you will, this dealer who only buys securities when the prices are high and interest rates are low. And if you do that long enough, if you pursue that strategy long enough, you're not going to be able to have future gains reliably offsetting current paper losses, right? If the Fed were expanding its balance sheet randomly, both when interest rates are high and when they're low, then the idea that things pan out in the long run, so the deferred asset strategy makes sense, itself makes sense. But I don't think it does in a world where the Fed only loads up on securities at times when their prices are exceptionally high.
Okay, yeah, understood. Yeah, so there's an inherent problem here where they have a trading strategy that almost not quite guarantees, but almost guarantees losses, future losses. Just
That's
by
right.
nature. Yeah,
that's right. That's what I think is the joker in the deck with this whole way of dealing with things. Mind you, because the Federal Reserve still has, it's responsible not only for its interest earning interest-paying liabilities that the bank reserves kept at the Fed, but it also supplies oodles of non-interest earning currency. And that's always profitable, right? That is, that non-interest earning Federal Reserve notes are supporting interest earning loans. And even if the interest earning securities that the Fed owns. So even if those securities aren't yielding very much, that part of the Fed's business is definitely a profit maker. That's where this real seigniorage comes in. And because it's large, the Fed has a lot of room for taking for losses in the long run. But over time, that can change as well. So I do think that there's a reason to be concerned about the Fed's balance sheet and the losses that sometimes are taking place in a mark-to-market on a mark-to-market basis on that balance sheet. I don't think it can be brushed aside as something that never can pose a problem.
Okay, great. Well, we've covered a lot of ground, so I just want to round off with a few personal questions. One is that some of our audience are relatively young and maybe graduating from university this year. What advice would you give to youngsters as they enter the real world?
Oh, well, don't go to university at all is the first piece of advice, but it's too late for you. So never mind that. No, I'm being partly facetious, but universities have become god-awful places. That's a fact. You got to do a lot of dodging in order to come out being at least as reasonable as you were when you went in. But as far as careers are concerned, pursue your passion. Be an independent thinker. Read widely outside of the syllabus, even if you have to not read the syllabus, but read widely so that you're exposed to views that are different from those you learn in the classroom and can think critically about the views you do learn there. And if you do all those things, I think you will end up with a good career. It's just very important to realize that learning is mostly something you need to do outside of the classroom. It's very, very important. And the world really could use people with good econ savvy who have thought a lot about problems. Right now, we have a lot of people who are fortunately interested in these issues, but too many of them, I think, haven't read widely enough, or they've read a few books that are very popular right now on various aspects of economics, and they don't realize that there's a depth of learning out there that's worth exploring, so that you don't get taken in by the latest fads, because there are always going to be fads. And what you want to have is the kind of knowledge that lasts a long, long time. And although it sounds paradoxical, the best way to get knowledge that lasts a long, long time is to read a lot of old stuff. That's my last one.
Well, you mentioned books, so let's ask
Yeah.
you. I mean, what are some of the old books that you'd recommend to people to read of any age?
In monetary economics, or just more broadly?
Both.
Oh gosh. One thing I recommend is that in your reading you include a lot of stuff that's not from your discipline at all. Read a lot of great old fiction if you want to learn how to write well, for example, because that's where the good writing is. It's not in economics articles, for sure, or books. As far as economics is concerned, read the classics. They're very much worth reading. I'm still a great Adam Smith fan. If you haven't read Adam Smith, you're missing a lot. Another economist who I'm very fond of in economics generally, but in monetary economics in particular, is the Swede Knut Wicksell. He has several books. One is a 2-volume set of lectures on economics. Is very, 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 very good. of course, the Austrians, Mises' theory of money and credit, originally published in 1912, was far better than any text on or any treatise on monetary economics written up to that date. It was really superb. And Hayek's work on business cycles, very, very interesting. Gosh, I could go on and on. There's an awful lot of good stuff out there that's worth reading. But really, it's just a question of just going out there and any title that seems interesting, give it a look. If you don't like the first 50 pages, move on to something else. But there's a lot of great work out there worth reading. The fact that it's old should never deter anyone. Oh, I'll mention two more works. William Stanley Jevons, Money and the Mechanism of Exchange. Great book. Great book. I think it might be 1880 or 81, something like that. And Lombard Street, which central bankers always talk about. That's Walter Bagehot. They always talk about it as some kind of Bible for last resort lending. Read the book and find out what Bagehot really had to say about central banks and last resort lending, because what he actually has to say is much more interesting and true than what central bankers make out of what they say Lombard Street argues.
And you said you're writing a book at the moment on the New Deal. When is that going to be published?
They say that they're planning for late spring, early summer next year. That's the publication cycle. You have two big publication cycles. I was too late for the fall, and the next one is the late spring. And so I'm working diligently to get my copy edits back to them so that we meet that deadline at least. And the book is called False Dawn. The New Deal and the Promise of Recovery, 1933 to 1947. And the reason it goes till 1947 is until you get to 1947, you don't know how the U.S. really got out of the Great Depression.
Okay, very interesting. Look forward to reading that book. And then finally, what's the best way for people to follow your work and hear what you're thinking?
Oh, it's by reading my stuff, of course, much of which is available on the internet, and what isn't available on the internet is probably available on Amazon. So, like a lot of people, like most people, when I do my best work when I can revise it, write it, and all that, and not just giving talks where you have to get it right the first time around. Though I also have quite a few online talks that people can look up if they don't feel like actually reading something. So it's all out there. I'm getting toward the end of my career, so I don't promise that there'll be a whole lot. I think this most recent book project may finally be the last straw. But I have a bunch of stuff that's out there, and I would be tremendously pleased if any of your audience looked at any of it.
Right,
I appreciate that.
And I do urge people to look at your author list on the your book list on Amazon and buy all your books. They're all really good, and follow you. I'll include links to all of that as well.
Great. And if they run into another Selgin online, a book writer, that's my brother Peter, who's written quite a few books, none of which have anything to do with economics. And if they buy some of those by mistake, Peter will be very grateful. If they buy them on purpose, he'll be doubly so.
I like that. Okay, well, with that, thanks a lot, George. Good luck with all your work and the book and everything. And hopefully we'll be able to do this again.
Oh, I'd love to. And thank you so much for inviting me this time. Really enjoyed it.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.